Chapter 7, Evaluating Investment Opportunities. How do you evaluate if it's a good investment or a bad investment, and what are some of the techniques? In one line, the summary of this chapter is conveyed very beautifully by this line. It says, "A nearby penny is worth a distant dollar." A nearby penny is worth a distant dollar. Think about it. It's very much important for us to know how much valuable the future dollar is of the investments that we make today. So how do we evaluate a dollar today and a dollar tomorrow? What's it's worth? So let's step back a little. Why are we doing this evaluation of investment opportunities? Typically, any investment opportunity starts with the senior executives, senior leaders deciding what game is our company playing. What is our game? And then once you know what game your company is playing, you need to know how you will win. And then what actions will you take so that you can win? What investments will you make? And based on those investments that you would make, you would actually have a chance to actually win, right? So the first step is for you to know what game you're playing. If you are a Google, then you need to know that, hey, your game is advertising, right? That's the game you're playing, really. And you do that by having the best-in-class search engine. And then how do we win? We win by marketing dollars, budget, right? And then what actions do we need to take? We need to build free services that are really good, like Gmail, Google, that people use, right? And then you'll have to start making those bigger and bigger investment decisions. So when you make those investment decisions, you need a way in which you can evaluate if it's a good investment decision or a bad investment decision. So how much capital are we putting in, and how much money or capital we're putting in, and how much money we will get out of this business? That's where DCF comes in, discounted cash flows. It's a technique for you to find out and evaluate, is this a good project to invest in, or is it a bad project? Is this the money that I'm gonna get out of investing in this project is a good one or a bad one, right? So it typically starts, and it's the fourth step, right? Once it starts with strategy, how are you, where are you playing, how you win, what you're not doing. And then when you know you have several ideas or projects, like in this case, an idea could be that Google says, hey, we want to build our own smartphone. That's one of the project. And so then you would want to use a discounted cash flow technique to find out, like, is this investment worth the return that we will get, right? And this is an art, right? It requires a lot of judgment because you need to understand how your the market that you're operating in is evolving. What's the competitive position of your company? What long run intentions you have for your business? What's your strategy to win over the long term? What are the unmeasurable benefits? You would want to keep certain people. You would want to build certain moat or presence. There could be so many factors to consider, but that's why it's an art, right? So, but we can get better at it. So let's get into it. So evaluating an investment opportunity involves just three steps, but these three are very critical. And we're going to cover the first two in this chapter, chapter 7, and then the third one in chapter 8. The first two steps is evaluating relevant cash flows. This is a very hard step. How do you know how much money this project will really make? And second, you need some sort of a metric that says, hey, look, this is how I'm going to measure myself to success. So those two things we're going to learn in this chapter. And once we know a metric for success and we know how much money this project will take and how much it will make, then you can say, hey, is this an acceptable criteria for my metric to actually be acceptable? Is this figure of merit good enough? So let's look at the first two steps in this chapter. And typically we draw a cash flow diagram like this, right? It takes a bunch of outflows, $40, and then over the next 5 years it pays you, and then there's some salvage value of $20 and gives you $10 every year. So we draw a cash flow with down arrow showing how much money it's taking out, an up arrow showing how much you'll get at the end of it, and then a constant set of cash flows that come out of it. A back of the envelope rough math to get an upper bound on if this project's worth it or not. You can calculate a payback period, which is basically you just look at these money that you're getting in, like 10, 10, 10, and 20, and then you say, hey, how much time do how many years do I take to get the $40 that I've invested? And it says 4 years, right? So it's like payback period's 4 years. You get your money back in 4 years. Another rough upper bound metric is accounting rate of return, where you say, hey, how much money is coming in, right? All the numerators, and how much money is going out, all the denominators. You just divide them, you know how much percentage return you will make. Again, the big thing that it's missing is time value of money, right? We've seen that a penny now may be worth a distant dollar, right? So time value of money is very important. Money grows over time, right? A dollar today is worth way much more than a dollar in the future. Why is that? So there are three main reasons. The first one is opportunity cost, second is inflation, and third is uncertainty with future, right? Opportunity cost is if I invest some money in this project, I could be very well keeping that money in a safe bank deposit and still be making money. So that's my opportunity cost. Or an alternative investment that I have that I could make and still make money, that's an opportunity cost, right? So typically any money lying around can make money. So that's your opportunity cost. Inflation, we know things get expensive over time. So a dollar today is worth more than a dollar tomorrow, because tomorrow's $1 will buy you less. So, you know, there's time value of money. So inflation reduces your purchasing power, and so the money today is worth much more than money tomorrow. Future is always uncertain, right? As time increases, as you try to predict up into the future, you know that there is uncertainty, and when there's uncertainty, there's risk, and so it's much more, the money today is much more valuable. The third piece, equivalence of money in different periods of time. How do I then calculate what is a dollar today worth or equal to a dollar like 2 years from now? So a dollar today, you can compound it with a compounded rate of return to get a dollar of the future, and similarly you can discount it to get the dollar back of the today. So basically it's saying that money in different periods of time can be equated by the compounding rate if you want to take the money today into the future, or a discounting rate, take the money off the future into of the money of today. And so you can compare them if you bring those money in the same time period, right? But you have to use these rates to bring them together. And Excel gives us a lot of equations that use these variables, NI, PV, PMT, FV, which we have seen. We can use in Excel to say, hey, if you know the number of periods, if you know the discount rate or interest rate, present value, number of installments that you pay, the payment amount, and future value, you can actually, if you don't have one, you can calculate using the Excel formulas. And we can use this for perpetuity, bond valuation, project valuation, and you can actually discount the cash flows that you're going to get in the future into the present value. That's the reason why this becomes most helpful. A really good metric is NPV, to measure how wealthy. NPV is how wealthy will you get if you invest in this project. So if you're $100 wealthy today, and if you take up this project which has an NPV of 10, then you become $10 more wealthy than what you are today. So your net worth becomes $110. So that's NPV, measure of how wealthy a given investment opportunity makes you if you invest in it. In a sense, it's the present value of the future dollars of cash flows that it will generate, the returns, minus the present value of all the current investment that it needs. So if you subtract the two, you will get the net present value, or the incremental wealth that you will build by investing in this project. It's a really good metric. It's not sensitive to it is sensitive to scale, meaning if you have a larger project, the NPV will be much higher than if you have a smaller project. The other metric is BCR, benefit to cost ratio. It's an acceptable metric as well. The formula is present value of cash inflows over present value of cash outflows. So if you do this, you will get a BCR greater than 1 is a good investment, right? So if you get more money, that's your numerator, inflows, and then you put in less money, outflows, and all in the same time zone, not in the same time period, right, in the same time, then that's a present value of all of those. So profitability index greater than 1 is a good investment. NPV greater than 0 is a good investment. So these are practical metrics that we can use to evaluate if it's a good project or a bad project. Finally, IRR is also a really good metric. It's called internal rate of return, but it's basically the rate at which, the percentage, the rate at which your money in an investment project grows. That's IRR, right? How much money does this investment make? The rate, and we know that if the cost of capital increases, that NPV decreases, right? Because if it's difficult to get the money to invest in the project, or if it's more expensive to get the money in the project, then NPV decreases. So the point at which NPV becomes 0, that rate is the IRR rate, right? Because at that point, you're saying that this project equates, the money coming in equals the cost of capital. So IRR is when NPV equals 0. And we know it intuitively because when the cost of capital goes up, right, NPV goes down, right? So the NPV is, if you see here, it's just going down as the cost of capital goes up, right? As the cost of capital goes up, NPV goes down. IRR is when it reaches 0. In a sense, for lower cost of capital, if a project grows at 10%, you get a higher NPV, right? So intuitively, it makes sense why and what IRR is the rate. Then, estimation of relevant cash flows. A lot of challenges, as I said. So we looked at various metrics. We looked at NPV, the really good one, BCR, IRR. We also looked at 2 other back of the envelope calculations, which is payback period and accounting rate of return, right? So there are a lot of metrics that we've come up with to evaluate if a project is good or bad. But the second part of this chapter is evaluating the cash flows, relevant cash flows. This is where the most tricky part comes in. As I said, you need to understand the business where you're in, the competitive landscape, your long-run aspirations, and so many other things. But there are 2 principles that are really powerful that helps if you want to calculate the cash flows very clearly. The first is cash flow or movement principle. You only count a cash flow as a cash that the project generates if the money actually moves. So things that actually don't move, like depreciation and other accounting things that actually don't make the money move, then that's not part of cash flows, right? So you don't count money if it doesn't move from your bank account. That's cash flow or movement principle. You only count money that moves. Second, with and without principle, it basically says if you invest in this project, that is with the project, and if you don't invest in the project, without the project, if you subtract the 2, and only things that differ between the 2 is what you should count as your cash flows. Meaning, if you invest in the project and it was anyways going to have this cash flow even without the investment, then you shouldn't count them, right? So with and without principles. If you use these 2 principles, you're better off to find out what constitutes a good cash flow, what constitutes a relevant cash flow, right? And you use these 2 principles and you can get really good relevant items accounted. Without it, it's hard. But there are still many challenges. So what are the top 7 challenges that you will still encounter to accurately determine your relevant cash flow? This is a sort of a checklist, right? The first thing is depreciation. We saw that this can be easy to do because we saw the movement principle, cash flow. Depreciation is just used for tax bills, which you should use it for, but add it back. It's not a real cash flow. You don't really pay for it. So don't count it in your cash flows. Working capital changes. Your inventory will go up, your receivables will go up. So those 2 would go up, and then you have your spontaneous sources of money coming in from accounts payable, wages accrued. So those changes are also to be factored in, like how much money extra you're spending in to increase your working capital. You need to ignore the sunk cost because that's already made. The cost has already been paid. The only way you evaluate whether you continue to invest in a project is to see what is the future benefit and what is the current cost. if the expected present value of the future benefit is greater than the present value of the cost that you're going to put in, then go for it. But don't look at all the past money that you put into the projects. Ignore them. Just look at the present benefit and present expected benefit. Allocated cost. Everyone knows that salaries grows. If you take on more projects, more people are going to be working more harder, and they're going to grow their salaries. But that should be ignored, because that's going to happen anyways. Cannibalization. It's better to eat your own lunch rather than having your competitor eat your lunch. So you should ignore cannibalization, ignore allocation cost, ignore sunk cost, ignore cannibalization, factor in the working capital increase, ignore depreciation, right? Excess capacity. If there is no future incorporated need or anticipation of using that excess capacity, then you can use it for free. But if you're using excess capacity from a team that's already factored in and has a future need for it, then you have to count it as part of your cash flow, right? Cash outflow if you're going to use their capacity. Financial cost, ignore for the most part, because your discount rate will take care of it, right? It's the cost of money or cost of capital. So if you think about these areas, you quickly realize that, hey, relevant cash flow is not only like important to have these principles in mind for cash flow and with and without principle, but looking at all of these checklists of things like, hey, did you double count? Did you not count it well? And there are two types of events. And finally, there are these real life tips, right? NPV basically says, hey, should I accept or reject this project? Because if it's greater than 0 NPV, you'll accept the project. But in real life, you don't just accept and reject project. You have to rank them. Why? Because there is capital rationing, meaning a company doesn't have a way to generate any amount of infinite money that you have. NPV says anything greater than 0 NPV, you should take the project. But that assumes that you can raise as much money as you need. That's not necessarily true. In real life, companies have a budget. They can only operate within a budget. So there's rationing. There's a fixed amount of dollars available. So you have to rank your investments, say, hey, look, I can no longer accept and reject just based on NPV. I have to rank them. The way you rank them is using BCR metric. We've seen that earlier. And you rank them on benefit cost ratio, and you use you go with the projects that give you the biggest bang for buck, right? So we've seen BCR, NPV, IRR, right? And you only take projects with IRR where IRR is greater than cost of capital, meaning you actually are making money. If your return IRR is less than the cost of capital, meaning you are losing money. So you shouldn't be taking those projects. Mutually exclusive projects. So a lot of NPV, BCR, IRR all expect that these projects are independent projects, meaning you can do each one of them independent of each other. Mutually exclusive projects are projects where you can only do one or the other. Like, for example, if you want to go to Seattle for work, you have a choice of mutually exclusive choice, which says I will either fly to Seattle or I will drive to Seattle. You can't do both if you're going from San Francisco. So that has a different impact, right? And when you compare these projects or compare these metrics, make sure that you compare with the same lifespan, meaning you don't compare 3 years lifespan with a 4-year lifespan, and you compare ideally with an average annual cost or average annual inflow, average annual outflow, to make sure that you're comparing apples to apples, right? And finally, should you use all of your money for the projects that are in front of you, or should you save for the future, wherein you might have a project with a much higher NPV, much higher IRR, a much higher BCR? Again, this is an art, right? And this chart does a pretty good job of like calculating. If you see here, it calculates the NPV, BCR, and IRR based on like this cash flow that we see, right? We see the cash flow year 1, year 0, it takes $40. And then every year for the next 9 years, it generates $7.5. And the year 10, it gets you 10. So the NPV for this is all Excel calculation, which we can use to calculate the NPV. It gives you that, hey, you're going to become richer by $9 if you take on this project. BCR is greater than 1. So that means that this is actually the benefit is worth the cost. And IRR is 15%. It takes in initial guess of 12%, and then calculates the IRR for you. So Excel does a lot of this. If you have this in Excel, you can calculate all of these metrics very easily. Similarly, this table does a pretty good job of like saying, hey, if you have an investment decision here to make, what do you do? What do you do? First, you have to check like, hey, what kind of decision is this? Is it an independent decision, mutually exclusive decision, or capital rationing based decision? Typically in real life, it's always this, right? Like you're always going to be like in a rationing, you'll have fixed amount of dollars, right? So you'll always go here, and then you'll find, oh, is this a mutually exclusive or an independent? And then you'll find, oh, I could actually like, these are all most likely. You could have multiple ways in which you can do the project. So you'll again go down here. These are independent projects, multiple projects, different types of, and then you say, hey, can I do like these projects in a fractional investment, or do I have to go like full in? If you do have to go in by full projects, then you just have to go with NPV. But if you can do fractional projects, then you optimize by BCR. And likewise, you will know what metric to use, what is available to you at various stages. So this diagram does a pretty good job in the textbook to find out like what decision to make, and helps us make the right decision. All right, thanks.